good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
Countdown to decision day. Futures gain. The yen weakens as the Fed and the BOJ begin their two-day meetings. Meanwhile, Microsoft kicks off the week's Mag 7 earnings. The focus this time, return on AI spend. And a $3 billion unwind. Berkshire Hathaway cuts its stake in Bank of America for the third time this month. Good morning, Manus.
Danny, a very good morning. Are you nervous? Everybody's nervous. Don't press the buy button on Microsoft unless you're really, really strong and bullish. A little bit of breaking news for you, Danny. We've got Eurozone GDP comes in at 0.6%. The estimate was for 0.5%. So better on the pan-European number, but Germany disappointed, down 0.1%. The bulwark, the core of Europe, is underperforming relative to Spain. Citiground downgraded China's growth yesterday, 4.8%. We're in a growth question mark, maybe even a growth scare. We'll talk more about that in a moment. And in part, that takes you down on the Brent price as well. You've seen Brent at a 7-week low, losing 3% over the past two sessions. And as I say, it is about global growth that is the drag there. And Bloomberg commodities are down 6% in July. Now to the NASDAQ. Everybody can breathe because we're getting ready for $10 trillion worth of market cap to be delivered. Microsoft is the name on the board. The nerves are being tested. We're almost in a correction, down 8%. Deutsche Bank say this. Growth, tech growth, has been extremely strong. It's moving from extremely strong to merely strong. Equity positioning is at a 2-month low. And then when it comes to the bond markets, everybody breathed a little sigh of relief yesterday. The funding needs from the Treasury dropped to $740 billion from $847 billion. That was pretty much expected. But also in there, the Dallas Fed numbers coming in at negative 17.5. And TD warned, take your profits on your bonds because there are lofty FOMC expectations. Danny, good morning. Are you nervous? Never nervous.
When you have a fifth of the S&P 500 reporting in just 4 names this week, of course, it's hard not to be nervous. But I think the way Deutsche Bank put it, Manus, is a really valid way to do it because earnings expectations are not as high, but they are still high. If you take it out quarters to come, we're expecting 20% or just about earnings growth for the Mag 7, save for Apple. That is a huge bar, and you get the feeling this week after Alphabet last week that it's going to be harder to impress than it is to disappoint.
It is, and the range of disappointment is going to be in the capital expenditure in terms of the hyperscalers, and we know that. Just the concept, Bespoke Investments sent out a piece yesterday, I think, which frames the narrative very nicely, which is what is irrational exuberance and where are we? And they look back to 1994 when we got the very, very first web browser, Netscape, and they looked at ChatGPT and Netscape and where we are. And we're still 4 months away, technically 4 months away, from when Alan Greenspan talked about irrational exuberance, and then we went on for another 3 years. Go on the tech.
And you could make the argument that it was easier to adopt the internet, as we talked with Torsten Slok about. You just sign up for a web browser than AI. Listen, I'm really interested for Microsoft today because I was looking at the SPLC function on the terminal. Meta, Microsoft, Alphabet, and Amazon make up 42% of NVIDIA's revenue. Microsoft alone is 20%. If they don't show up today, then NVIDIA has a big problem. If they start talking about pulling back on some of their CapEx, this just comes straight back to NVIDIA. It's a concentrated market, and their revenue is very concentrated. And the
other story, we'll touch on this in a moment, Samsung making up ground in terms of the ability to deliver some of those chips to NVIDIA, and that in some ways takes a little bit of heat out of the supply chain. It's just another part of the narrative.
Right, totally. Okay. Wisdomtree's Aneeka Gupta weighs on that big week for earnings. She writes, quote, a risk of returns being so concentrated is that when those companies fail to meet expectations, their performance suffers. Forward earnings growth looks set to expand beyond the current leaders. Aneeka joins us now. She's the director of macroeconomics research at Wisdomtree. Aneeka, great to see you. It's been far too long. Listen, from reading that there, you sound like someone who wants to buy the other 493 names.
Absolutely, Danny. We are seeing that rotation take place. It's been quite a fierce rotation out of the large caps into the small caps. And I think there's been a number of catalysts bringing about that rotation. First and foremost, we're now seeing a higher probability of those rate cuts being priced in by the Federal Reserve. And this has been on the back of softer inflation prints. And at the same time, we have been seeing a bit of risk on the upside to the labor market in the U.S. And I think the culmination of expectation of easing of interest rates in the U.S. alongside the narrowing of earnings gap between the large caps and the small caps is also aiding the small cap sectors.
Aneeka, good morning. Look, it depends which research house you read. There's Laurie Calvasina and a number of others saying, don't rotate now, the earnings aren't there in small caps. My question to you would be this. You talk about the concentration. We know the concentration is in the Mag 7. It's the most concentrated, you say, since the 1970s. So here's the risk reward. Do I trim back my Mag 7 exposure, or what is the danger in doing that? I know we had a leg lower from NVIDIA last week by 9%, but is it trim the Mag 7 and actively add on the broader names?
Yes, it's very much adopt a bit of a barbell strategy where you hold on to your existing exposure to large cap tech, trim a bit, and within that exposure, if you trim a bit of that and add on to a bit of an exposure within small cap value and small cap quality, that would just broaden out your exposure and keep it a bit more balanced, as opposed to having this narrowing breadth, a narrowing concentration within the U.S. equity market. I think that would aid investors, especially given the change in the broader macro scenario that is playing out.
I think one of the things, though, that caught a lot of people by surprise last week, Aneeka, wasn't necessarily just that big cap tech unwound, because so many people have been calling for that. It's the fact that basically every consensus position was punished last week. And a lot of folks have been pointing to the rapid appreciation of the yen, saying that it caused ripple effects. Do you worry about some of that correlation in markets, that faraway markets like Japan and the yen can have such an impact on big cap tech?
Absolutely. I mean, right now, we know we are seeing an over-concentrated position where investors are essentially net short the yen versus the US dollar. And that has been predicated on the wider interest rate differential between the US and Japan. And clearly that is beginning to narrow. As we've seen expectations for Fed rate cuts being priced in, that gap is narrowing. We also have the all-important Bank of Japan meeting. And there is a higher probability that the BOJ increases rates by 15 basis points today. And I think that is also playing out into this appreciation that we've seen in the yen, alongside the intervention that we've had from the Bank of Japan. But I think it's very important for investors to keep in mind, the conservative outlook that Japanese corporates have put forward. Japanese companies for financial year 24 have actually put out a very conservative estimate for their forecast for yen dollar, which is at 144. Mm-hmm. And already in between April and June, we had quite a bit of a quite strong correction and an easing of yen versus dollar. So that's given Japanese corporates a bit of a reserve. Even after we've seen this recent appreciation in the yen, I would say, Japanese companies still don't need to, cut short on their guidance, and that's because for companies to change that initial forecast that they've kept of 144, we'll have to see nearly 3 more quarters into the financial year 24 showing a much stronger yen, and that's unlikely to take place. And that's why we still believe that Japanese corporates are in a strong position to weather out the recent appreciation that we have seen in the yen versus the dollar. And
you make that point really clear, is that the appreciation in the yen, it's a recovery in real wages, it gives domestic households a purchasing power, so the domestic story remains in track. Look, let's just close off very quickly. We've had McDonald's with a drop in terms of spending. We've had Heineken pressures here in the United States of America. Diageo pressures again in terms of transferring to lower branded whiskies. A favorite phrase of ours on this show is about the exuberance of the U.S. consumer. What is it? The
hedonism.
The hedonism. Thank you, Danny. The hedonism of the U.S. consumer. When you read Heineken, McDonald's, Diageo, do you worry that we're now jumping off from a growth question to a growth scare, and perhaps cracks in the consumer really becoming manifest?
There's no denying that we are seeing a slowdown in the economy. But what's important to keep in mind is that so far we've had a numerous amount of headwinds hit global equity markets, and they've been able to weather the storm. So now that we're seeing this slowdown take place, it is coming at a time where we're also likely to get the easing of monetary policy globally. And hence, while we will end up seeing a bit of a slowdown, I think the global equity markets will be able to weather the headwinds that we're facing with the global growth slowdown, alongside a much faster pace of monetary easing by central banks globally. And that should also help bring about a bit more momentum as we head into year-end for equity markets.
Well, let's see whether the Fed's actually listening in and taking heed of former Fed governors and yourself. Aneeka Gupta there of Wisdomtree. Get ready for that cutting cycle. Other stories on your Bloomberg terminal. This is what we got for you. BP maintains the pace of its share buybacks and increases its dividend after posting strong results in the second quarter. The British oil major reiterated that it will purchase $3.5 billion worth of shares and greenlit an oil project in the Gulf of Mexico.
Manis, here's one of the stories you mentioned, that a slowdown in Latin America, the Caribbean, and the U.S. have all pushed British distiller Diageo to its first annual sales decline since the pandemic. CEO Deborah Crew told Bloomberg that U.S. consumers were indeed reining in their spending.
We are faced with a challenging U.S. environment, just like many other consumer-facing companies. We're calling it a cautious consumer, a U.S. consumer that's quite cautious in spending. Wallets are under pressure as inflation is persisting. You're seeing, 30-year high grocery, food basket prices, and that has certainly impacted us. Additionally, interest rates remain high, and so that's impacting retailers. We've had some retailer destocking this year.
As we've been saying, France and Spain each delivered growth that beat expectations in the second quarter. Both countries matched their first quarter growth rates and exceeded the median forecast of economists surveyed by Bloomberg. The French report only partially captures the impact of the country's snap election.
Coming up, Berkshire Hathaway has unloaded $3 billion of its stake in Bank of America in just this month alone. We're going to have more on that next.
And the Fed should have already started cutting rates. That's according to Mads Pedersen of Edge Investment Technology. He joins us later this hour on why he's long of equities. Bloomberg Brief. I'm Menace Cranley alongside Danny Berger in New York. Now, Berkshire Hathaway has just cut their holding of Bank of America. It's for a third time this month. That's a total of $3 billion unloaded by Warren Buffett's firm. Charlie Wells is standing by with the narrative. I just wondered, to what extent is this, I've had a great run, I put $5 billion in at the start, I've had a monster dividend, the run is done, or is it something more significant about a call on banks? Charlie, good morning.
Good morning. I mean, Manis, this feels a little bit like a summer trim. I think we see that $3 billion figure and we think, huge amount of money for pretty much any person except Warren Buffett. Now, this is Berkshire's biggest pullback from Bank of America, but they still remain, the largest holder of Bank of America. Their shares worth about $40 billion there. But of course, this is sort of value investing 101, Buffett getting in back in 2011. Those shares from that point are now up 488%. So if he wants to take a little bit of a trim, I think we can let him.
Fair enough, Charlie. And of course, like the genesis of the story, that he's in the bathtub after the financial crisis and he decides to buy Bank of America. And Warren Buffett has been someone who's really invested a lot in banks in general. But in the past few months, Charlie, we know that Berkshire reworked some of its banking holdings. Is there some sense of it's not just Bank of America, it's banking that Berkshire wants to change?
Danny, that's a great point. I mean, they do tend to make these kind of tweaks around the edges. And what's striking is it can feel a little bit like banks may be at something of a pivot point. So they had a really good first half. We're kind of just about done with global bank earnings. That KBW Bank Index is up, I believe, about 19%. But in some of these earnings, you see a really positive story for that first half. Deals coming through. You see net interest income holding up fairly well, but there's uncertainty ahead. A lot of those deals have been prearranged. There's questions about rates and how long loan demand can hold up. So if you're looking at banking, you've got $3 billion of evidence that a value investor that everyone knows was willing to kind of take a little bit of, potentially take a little bit of profit now ahead of some uncertainty.
Yeah, I mean, but everyone else in the market has been going gangbusters on especially these regional banks. Charlie, we appreciate it as always. Charlie Wells there. Okay, let's turn to tech. 4 of the Mag 7 report this week. It's Microsoft after the market close, followed by Meta, Apple, and Amazon through the rest of the week. That represents a fifth of the market cap of the S&P. But a market rotation has seen the Mag 7 shed over $1 trillion in market cap in the past 3 weeks. Let's get over to Bloomberg's Tom McKenzie to walk us through it. Tom, we had Alphabet last week, a disappointment. So when it comes to Microsoft, can they really show up in anything that will set their earnings, set their share price higher, or do all we care about is what they're doing with AI?
I think that's where the focus has got to be. Look, there's a read across from Alphabet for Microsoft and two lines that tie in from Alphabet to Microsoft. One is on the cloud business. Alphabet performed well on that front. Expectations are that Microsoft is going to come through with growth of about 30% for cloud and for Azure. So watch for that. The other line that you can tie and link from Alphabet to Microsoft is the CapEx, the spending on that AI infrastructure. And that's where the concern was for investors in Alphabet last week, despite the top line beat on the earnings story there. Microsoft expected to ramp up its spending from about $11 billion to $13.3 billion. Anything above that could cause jitters. Analysts telling Bloomberg, look, inline earnings, inline results for companies like Microsoft, not good enough. They're not going to be good enough for investors out there. They need to come through with a solid beat. So watch cloud and watch the spend on CapEx around AI.
Yeah, well, inline is mere bagatelle. It just doesn't deliver. Look, talk to us about AMD. Chipmaker has been lagging its peers. You could say that. Just looking at the quarterly results so far, hardware and semis quarterlies beats. You've got 8-1 beats so far. AMD's got a lot of work to do today to convince us, haven't they?
Stock is down 5% year to date. It is a competitor to Nvidia, but the gulf, as you suggest, is wide in terms of that moat that Nvidia has carved out for itself. What I'm going to be watching from AMD is whether or not they raise their sales forecasts around GPUs, the graphic processors, the AI accelerators. Currently, they set themselves a target of about $4 billion US. That is just a fraction of Nvidia. If they raise that target, that, of course, will be welcomed by investors. They got the PC part of the business, they got the service part of the business, they got the gaming part of the business, but the focus for AMD will be on those GPUs and whether they can build out that market share and start to nip at the heels of Nvidia.
Well, there's one thing taking market share from Nvidia. There's another thing being tapped as the person that can make those chips for Nvidia, and Samsung is making some breakthroughs in the chip space too. Samsung has been a company that has really lagged. It's seen smaller rivals catch up to it. Is this a sea change for them?
Yeah, this has been an embarrassment, frankly, for Samsung, which is the world's largest maker of memory chips. As you say, they've faced that competition from SK Hynix and others. They are behind when it comes to that. But you're absolutely right. Nvidia basically has come out and blessed one of their latest memory chips, the high bandwidth memory chips that they produce, the HBMs. So that is a significant positive for a company that now is on track, it seems, to try and close that competitive gap with SK Hynix. So we are going to be watching that from the results coming out from Samsung. The expectations, by the way, top line, is that you're going to see a jump in net income from this company, the largest jump in at least a decade.
Well, all eyes down for that. I mean, that high bandwidth memory business is going to go from, what, $4 billion bucks last year to something like $70 billion in 2027. So being right and being well positioned in it is critical. Tom, good to see you. Tom McKenzie on the tech agenda. Coming up with Danny and I, a look ahead to the rest of the headlines around the world. Governor Roy Cooper drops out of the race for VP. Context matters on Bloomberg.
It's your Bloomberg Brief on this Tuesday. Danny Berger alongside Manus Cranny in New York. Okay, let's go through some of the front pages this morning. A look at what's making headlines, Manus. The Washington Post has this on their front page, that North Carolina Governor Roy Cooper has pulled out of the race to be Vice President Harris's running mate, writing on X, "I was honored to be considered for this role. It just wasn't right time for North Carolina and for me potentially to be on the national ticket." He was never really vetted. He didn't allow himself to be part of that process. Harris is expected to pick her running mate by next Wednesday, August 7th.
Yeah, let's see if it is a swing state that makes it into the race with her. Next up, protests erupting in Venezuela. This is as the nation has denounced the election results. Maduro's government ejected 7 diplomatic missions and Latin American countries that condemned his claim of victory, which he made despite the reports of fraud, Danny. The opposition leader claimed to have evidence that Mundo Gonzalez won won the election over Maduro.
And on the FT, I found this story so interesting. Essentially, Amazon's Prime is going to be charging a cheaper rate than Netflix for advertisers. And this is a big deal because the competition is crazy in this market. If you think about all of these streaming platforms, most of them have an ad-based platform on it too. Apple is supposedly going to have one soon. But Amazon is so interesting, Manis, because they know everything about us. If you're an advertiser, you would love to give money to Amazon. Not only is it cheaper, but they know I like to buy, I don't know, expensive toothpaste so they can target me with expensive floss, I guess.
Now we know what Danny does on Amazon Prime and has delivered.
It's the best.
Look, I think this is about the commoditization of advertising as well. It's a high margin business. Citi reckon that this could add like $5 billion to their numbers. And if you think about it, they've already got some advertising revenue streams. That's at nearly $12 billion. So this is about going head to head with everybody else and the commoditization of those rates. And one way that happens in advertising when you commoditize the rates, and it's usually a little bit south.
Yeah, it's a race to the bottom, and it's a problem for Netflix because in their most recent earnings, they had space to sell. Yeah. They hadn't sold up all of their ad slots, and their argument was, look, we have a lot of people on our platform now, the ad-based one, so you should give us money. What happens when there's a cheaper option out there?
Well, I'm waiting for our Apple Plus to introduce their adverts and interrupt my viewing. But coming up, we're going to talk about how long you want to be of this tech market with Mads Pedersen.
From our global headquarters in New York, I'm Danny Berger alongside Manis Cranny. Let's set your agenda.
Countdown to decision day. Futures gain and the yen weakens as the Fed and the BOJ begin their deliberations over the next 2 days. Microsoft kicks off this week's Mag 7 earnings. The focus, return on AI spend. And a $3 billion unwind. Berkshire Hathaway cuts its stake in Bank of America for the third time this month. Danny, good morning.
Good morning, Manis. So in a little under 5 hours, we're going to get JOLTS data. Then after the market, we'll get Microsoft earnings. Plenty to keep us busy ahead of both meetings from the BOJ and the Fed. At the moment, S&P 500 futures up about 0.1% after barely eking out gains yesterday. So that rotation trade takes a breather. Russell also falling yesterday. Now it's the turn of earnings to show up. Your 10-year yield, that has barely changed this morning. 4.18 is where we stand. One thing that is helping take some of the pain out of this bond market are commodities. Manis, you pointed out this to start the show. The Bloomberg Commodity Index has erased all of its gains for the year. We are now flat on that. So that also helps really push forward this rate cut story. Meanwhile, the yen turns from appreciation to declines. Dollar gaining about 0.5% versus the yen. Simon White from MLive has this fantastic statistic. Yes, the data sample is small, Manis, but out of the past 10 meetings, every time Ueda has spoken, the yen has fallen. There has yet to be a BOJ meeting with Ueda at the helm where you see yen appreciation.
Yeah, it's now going to be a debate getting through that 150 level. And a lot of people have said, look, that's going to be very, very difficult to do. I think you're right. When it comes to the growth outlooks, overall Europe, actually beat on the estimate, but Germany was the drag. And then you reflect back 24 hours ago, we got a breaking headline from Citi that they were downgrading China growth to 4.8%. And that explains in part the pressure that you've had on commodities, which is actually all pretty good news for a central bank out there. If oil is on the downside 7-month low and commodities give up this year's gains, it's just another layer in the cutting cake. It's not the closer,
yes,
but it's there.
But you get this feeling that we are walking just such a fine line because you look at those things, you look at slowing global growth and the appetite for commodities, and you say, that's great, it means the Fed can cut. But at some point, you need to be concerned that that slowing turns into actual slowing growth enough that you get concerned. For the moment, this is a market pricing a soft landing. Things are going to slow to a perfect amount, and we can get through it, and small caps can rally, and everything will be wonderful. But you hear from all these former Fed officials writing, like Bill Dudley, for example, and Alan Blinder, saying that maybe we're walking a finer line than this market is appreciating.
Yeah, and that's their point, which is, cut earlier. There's a wonderful saying at home in Ireland, which was about voting. Vote early and vote often, which is cut early and not necessarily cut often, but make sure you've got the right amount of cutting because rates are tight. Real rates, according to a few people out there, are a little bit tight and restrictive. Let's shift the agenda along. You're right, we're counting down to this growth number from Microsoft. What are they spending on CapEx? Mads Pedersen is our guest for the next couple of minutes over Human Edge Investment. And as far as technology is concerned, this is what he says. In our dynamic allocation strategies, we're fully invested in equities. That is 100% versus 60% in the benchmark. We're focusing primarily on large cap growth stocks, maintaining our preference for U.S. equities. Mads Pedersen, good morning. The world is focused on the Nasdaq. We're on the brink of a correction. We've got dynamic movement in portfolios from large tech, rotation into the Russell, etc. And yet you are committed. I've never read a more committed note. Fully invested in the dynamic portfolio, 100% in equities. Why are you so bullish and committed?
Well, thank you very much for inviting me. I think I'm most often quite committed like this, maybe 70% of the time. So it's not quite as unusual, but let me give you the reason. We've had a sell-off in equities, which is extremely small compared to the almost 100% gain in S&P the last 5 years in total returns, including the dividends and buybacks. We are seeing a situation where earnings have been extremely strong the last 3 quarters, 4 quarters, and the last 3 years. And we are seeing that the technology companies, which are increasing in cap, are also now the largest sector in terms of earnings. So they're actually transforming people's optimism into real growth. Yeah. So we're basically just saying the US financial market will stay great, and this is where we want to run the risk. We run risk for our clients to get them good returns. And we definitely hope Microsoft will report well tonight, but we notice that the reporting season so far has been very positive, and the last 12 months of earnings are up 12%. So it looks good on the surface, and then there's a lot of things to worry about, which we can then talk about.
Should we talk about the things to worry about then, Mads? I'll take your optimism and sprinkle some concern in there. Because you do look at some of these earnings, sure, on the headline level, it looks good. But you have issues like the airlines, the autos, the consumer stocks, something like McDonald's, too. It's sector by sector exposed to the consumer that's reporting some pain, reporting that there is pricing fatigue. How much do you look at that and say this is a wholesale issue, or it's some of these individual companies having problems and not adapting quick enough?
It's a real issue, and it's especially a real issue for the consumers. But it's not a secret that the world has become more unequal or uneven the last 10 years. These are not the companies which drives the global spending. McDonald's is an extremely famous company, but they don't have a humongous investment budget which drives profitability of global markets. So what we have seen, which has maybe drowned a little bit in the story, is that a lot of the European strong companies like LVMH, like Novo, like some of these growth companies have had issues with different things, but primarily the concern here is the Chinese consumer, because if China doesn't get going, then Europe can fall off. I'm not very concerned about the US consumer. Look how much house prices are up the last 5 years, how much wealth has been gained. It is painful for the average consumer, but the average consumer is no longer driving the world economy.
You say China is perhaps one of the most underestimated risks. Citi downgraded their growth yesterday. They're just one house, Mads. Some people would criticize what's piecemeal response mechanism in small rate cuts and not enough to bolster the consumer. Why would you describe it as being the most underestimated risk? How bad can that get?
It can get really bad. It can get so bad that Europe goes from recession to depression, because what we are seeing now is that the German companies and the European growth companies are disappointing. We saw Heineken take a big write-down on their assets in China. So what if US falls into a temporary recession? Then Germany has no external growth. Then Europe has no growth. Germany didn't grow, as we just saw this morning in the GDP numbers. We get a recession. Then you have to reprice real estate in the European real estate funds. They have to sell real estate, which is already declining. And we're back to the euro crisis. So it can be pretty bad if it goes all the way like that.
Okay, if that's Europe, you say in the U.S. the Fed should have already started cutting rates. There are two different opinions of this, Mads. Let's just take the op-eds we've had from former Fed officials. You have Bill Dudley, who says they are increasing the risk of a recession by not cutting this week. Then you have Alan Blinder, who says, no, it's not necessarily that it's an increase of a risk of a recession, just all the stars have aligned, and therefore they should cut. Which side of this do you stay on, Mads?
I stay on Bill Dudley's side, and I hope he says the same when he's a member of the board at UBS, so that they don't get into the problems they usually get. We hope they will survive better next time there's a crisis in the US. But what we really hope is that they will realize that there really is no need to keep rates so high. inflation is coming down nicely. It's not coming down in a straight line, but when did a macro number last come in a straight line? And rates don't need to be so high. They can just cut 25 basis points on the next 3, 4, 5, 6 meetings, and we can land at 3.5. That would be nice and smooth. We don't expect they'll do it this week, but that would be a nice and smooth way to take away a bit of the pressure, because a lot of the US economy is not doing as well, and we can maybe even get a rotation in the housing market.
Now, come on, Mads, we'll put it back at you. You're the one that said that nothing ever goes in a straight line and that nothing's ever exactly as you see, as it seems to be. You're talking about a pretty hefty cutting cycle there. A lot of our guests have said to us, it'll be a tweak now and a very much a delay. So are we in policy error? Does that matter? Does that phrase matter? Are they behind the curve? Are they in policy error in your view?
If we were ever in policy error territory, the only place where we are more in policy error than in the Fed is obviously ECB and the whole Chinese policy framework. Yeah. So we are deep into a fascinating global boost to growth from technology, and a fascinating area where we need to take notes of every central bank meeting to see what we can learn of the mistakes they're making at the moment. So yes, we're deeply into it, and the Fed should cut 25 and the ECB should cut 50.
But Mads, this is the complicated thing, is if you take us back to the start of the conversation, you even kind of mentioned it there, you could build a case for them waiting. As you say, technology investment is driving so much of this economy, and that's still happening strong. You look at some of the headline data, GDP for the US, that came in stronger than expected, as did retail spend, as did PCE figures, Mads. So what's the rush? What's the difference of a couple months?
Well, the rush is that when you stay in tight territory, you don't know where things will next break, and you don't get the growth to widen out as it should. So you have this awkward situation that basically the boomer generation, they're sitting on enormous wealth gains in equities and houses, and the younger people cannot get into the housing market. Why not start working on this? And the younger people are not like young, yeah? It's like people, almost people my age. I don't claim to be young, maybe 10 years younger than me. It's not like that. It's just take this generational change and move on with it, and ease some of the pain in the lower end of society instead of trying to strangle it. There was a policy mistake done before by being too easy too long. Don't redouble your policy mistake by being too tight too long.
You're telling me you're not Gen Z, Mads?
It's a fear of forecasting.
And can I just clarify? Really. I'm not a boomer. I just want to put that out there.
Good clarification, Mads, it is always such a joy to catch up with you. Mads Pedersen of Edge Investment Technology. Come join us again soon. This is Bloomberg.
Bloomberg Brief. I'm Manus Granny alongside Danny Berger in New York. We're counting down to the Microsoft earnings. They're on deck after the market close. Here to take us through what to expect, it is Tom McKenzie. Tom, it's CapEx. We just had a very bullish conversation with Mads Pedersen in terms of the allocation to tech. He's all in, and it's going to be a pretty big growth momentum that's delivered. But this is going to be about CapEx today from Microsoft, isn't it?
It really is. Look, last quarter they came through with an uptick in terms of CapEx. All of that, of course, or at least the majority of it, focused on that artificial intelligence infrastructure. So the chips, of course, the GPUs from NVIDIA, but also the data centers in which they sit, of $11 billion. That is expected to move up to $13.3 billion. If it stays within that range, possibly a comfort area for investors. Much above that, though, could cause concern. You saw that reflected in Alphabet last week when their CapEx spend came in higher than many had expected. So that's going to be key. The cloud computing part of the business, of course, it ties together because it sits on that data center. So Azure, that is expected to see pretty decent growth, upside of about 30% in terms of the revenues that come through for cloud for Microsoft. So those are the two key areas to watch for, is that CapEx spend, is the demand for cloud. But again, as one analyst who's quoted by Bloomberg has said, in-line results will not be enough to assuage investors. You need to have a really solid beat and expectations that, in terms of that spend on AI, they are able to close the gap in terms of the spend and the monetization.
And Alphabet is maybe the poster child for that. You had solid cloud results, you had inline, and yet the shares fall. And Tom, I think it's easy in this week to get caught up in the idea that we have 4 of the Mag 7 reporting, 20% alone for market cap. But we can't forget that chip makers are also reporting. We get AMD today. How much are those reports also going to set the tone for this tech earnings season?
I think AMD is really fascinating. This is a stock that's down about 5% year to date. That compares to 60% gains year to date for the semiconductor industry in the S&P in terms of that component. So that's the comparison. There's a lot of catch up for AMD, and the focus for them, the scrutiny, will be on their AI accelerators and whether or not they are able to ship more of those than has been expected, whether they're able to close the gap with NVIDIA. They've guided for this year revenues around those AI accelerators of around $4 billion. Cantor Fitzgerald says if you see a number closer towards $5 billion, if they revise it up to around $5 billion or closing into $5 billion, that will be very positive for this stock. But there have been rumors that Microsoft has pared back some of their orders for AMD's AI accelerators. Just rumors for the moment, but we'll see if that gets confirmed in these results. They don't break out the AI accelerators within the earnings document, by the way, so you'll have to listen into the call for the details on that.
Tom, thank you very much. Bloomberg's Tom McKenzie there on tech earnings. Other earnings out there, Airbus, it will report results after the European market closed. The plane maker did issue a profit warning last month, citing continued supply chain constraints. We're also going to hear from Boeing tomorrow. Joining us now is Sid Phillip, who helps lead our airline coverage. Sid, the airlines themselves, let's set aside the plane makers for a moment. They've reported earnings that have showed a slowdown in demand from consumers, when previously we thought the issue was that they couldn't get their hands on enough planes. So let's bring the plane makers back into that. What does it mean for them to have these airlines all of a sudden in a position of overcapacity?
Morning, Danny. So yeah, for the airline industry, obviously there is an overcapacity problem in certain markets. We've seen that happening in the US. We've seen some European carriers also talking about issues with yield. And it hasn't yet boiled down to airplane manufacturers because Airbus and Boeing both have backlogs that stretch well into the next decade. And so for them, essentially, they're sort of struggling to produce enough planes. I mean, Airbus has talked about how supply chain challenges have forced them to cut their annual delivery target to 770 this year from 800. And essentially, we're looking for any commentary on how the supply chain is doing and how Airbus will be able to sort of get by these supply chain issues and actually be able to ramp up production to where they want to be. And on Boeing, again, we've sort of seen Boeing slow down production as they get into the whole as the FAA restricted them from raising production in the aftermath of the door plug blowing out in January. And so, again, we're looking to see what Boeing talks about in terms of how they can get production up and get those deliveries going, because deliveries are vital for cash flow, and both manufacturers desperately need the cash.
Well, I can verbalize for you the frustration in the airline industry. Guy caught up with the Fly Dubai CEO. This is a moment of pure frustration. They're waiting on 10 MAX aircraft. They only got 4 of them. Whatever our patience has been, this was way too much. This will have a major effect on operations. So we're all going to pay the price at some level on these delays. You talk about what we're going to focus on from Boeing. Until those restrictions are lifted, how much more pressure is there on the cash burn that we saw in the first half of the year relative to what's going to happen in the second half of the year, which is critically important to the US banks?
Absolutely. I mean, so Boeing has burned through about $8 billion in the first half of the year, and they desperately need to get cash going again in terms of deliveries and get sort of be able to ramp up cash generation in order for them to sort of meet those annual targets, and as they can sort of come out of the hole that they're in at the moment. Because, I mean, Boeing's had a sort of run of bad luck in terms of they've had issues with 787 deliveries, they've had issues with 737 MAX and production, and they sort of desperately need to get their production and deliveries going again in order to start generating cash and essentially meet their targets.
Very generous description, Sid. A run of bad luck. Other people might be a little bit more aggressive. Sid Phillip there on the very latest for the airline industry. Let's pivot to the banks. Standard Chartered, the stock is romping up this morning, up 6.63%. They've announced a $1.5 billion share buyback. Let's listen in to Bill Winters, the CEO.
What we've said to shareholders is we've got a strategy. We're pursuing the strategy. It's working quite well. Earnings are strong. We're managing our capital very, very directly and I'd say quite actively. And that's allowed us to return any surplus to shareholders. And we said, especially given where our stock price is, which is not as high as we think it should be, we will buy back as many shares as we can with surplus capital. That's what we're doing. If we keep on performing, of course, we can keep on buying back shares.
Bill Winters there in his 10th year at the bank and one of the longest-serving CEOs of any major UK lender. Charlie, good to see you. This is about delivering on the Fit for Growth narrative, the big rip-up the bank program that he has had. I'm hearing a lot of internal angst at the bank. So is this a soothsayer with a buyback for the market?
Certainly. I mean, he was looking quite chipper in that interview. And I mean, one of the really positive stories to come out of this report was wealth. And this is the sort of story that any bank would be envious of. Operating income for wealth was up 25% for Standard Chartered for wealth. So that is certainly something that they're looking to bolster as we go into an era when rates could be coming down, hitting other parts of the business. But of course, investors were razor focused this season on expenses. And that Fit for Growth was a plan, not just to cut expenses, but what was interesting in Winters' interview today is he talked about some of the structural changes that they've tried to make. They've stripped out management layers across the globe, and that could be causing some of that consternation, Manus, that you're talking about.
If we zoom out, Charlie, one of the other big stories this morning is Warren Buffett cutting his stake in Bank of America by $3 billion, cutting it 3 times in the past month. We just finished bank earnings. I know we also got Nomura earnings that beat today. I wonder if we look at something that Buffett did and say maybe it's not as good as it is out there, as many people think it is. Should we read anything into it like that?
I like that skepticism, Danny. And I mean, look, you look at the charts for these major banks, and they've been outperforming the S&P, the KBW Bank Index is up. And so, you know, I think there's something of a contrarian take here that, look, the results have been good. We're seeing, you know, deal flow healthy again. We're seeing, you know, markets businesses doing well. But how long does that continue? I think one of the really striking points that our opinion columnist Paul Davies made was that a lot of these deals were clocked already. They were expected. And so what does the deal flow look like going to the second half? What do markets look like? And what happens with not just this rate uncertainty, but also the political uncertainty that we're facing in the United States? That could all play a factor. And I think if there are investors who are looking at this as something of a pivot point, they may have a point.
Fair enough. Charlie, appreciate it. Charlie Wells there. Okay, coming up, we're going to set you up for the trading day. We have a lot of earnings, a lot of data. We'll get a little bit of jolts, a little jobs. That's to come. All right, let's get you set up for your trading day on this Tuesday. We're going to get a lot more earnings. Another about a third, I think, reports this week. Before the bell, we're going to get reports from PayPal, Pfizer, and Procter & Gamble. And then we're going to get JOLTS job openings and consumer confidence data, those at 10 a.m. Eastern time. Plus, the big one comes after the bell. That's Microsoft. It'll also be accompanied by AMD after the market close. So plenty to chew over, Manus, before we get those Fed and BOJ decisions.
Yeah, a couple of small movers, Danny. I mean, there's a little bit of nervousness ahead of the Microsoft numbers, but this is what we got for you. CrowdStrike, they slide. The report is Delta is looking for compensation. Lattice Semiconductors, chipmaker, where revenue forecast came in below the estimates out there in the market. And of course, we're counting down to Microsoft, and I think we said this a couple of times, which is it's going to come down to the capex, it's going to come down to the belief in the monetization, and they're maybe a little bit further ahead when it comes to the monetization with their product in the cloud.
I don't think we should overlook its impact on NVIDIA. 20% of NVIDIA's revenue comes from Microsoft, so if they don't show up, it could knock down one of the stars of this market.
Yeah, and we're counting down to BOJ and the Fed. Good morning from New York.